Hi, everyone. Welcome to the webinar. We're going to start in a couple of minutes here, just waiting for people to trickle in. But if you wanted to send through on the questions panel where you're from, it'd be great to kind of see where we have people representing from throughout Canada. So if you wouldn't mind just sending a quick message to me on the question bar. Oh, that's great. Perfect. Thank you so much. Oh, this is, wow, lots of all over the country. So it's really nice. Okay, so in the interest of time here, I'm going to get started. So keep on schedule 1:30 here. So everyone should see my PowerPoint. So I'm just going to tell you a little bit about myself. My name is Andrew Zachariah. I'm a chartered accountant. I started an accounting firm, my own accounting firm in 2014. And my background prior to that is I worked at PricewaterhouseCoopers. So I've had my own practice now for 6 years. And if we fast forward to today, I have 10 staff. We really focus on a couple main things. One being bookkeeping or a outsourced finance department. And then the other thing we do is the annual tax filings and planning for clients. So, really we've pivoted into, especially now more so than ever, just being there as a finance partner and helping our clients out and helping guide them through the next steps of wherever this evolution is that becomes the pandemic, hopefully is in the past at some point. So that's really what we do. And today I'm going to talk to you about cash flow, because cash flow is really the most important thing that any business owner needs to be aware of, not only for your clients, but even your own business as an accountant. And this is something that I've learned as I've grown my business. Initially when you're by yourself, it's not as much of a consideration because, step one, you start a business and let's say you go solopreneur, and maybe that's where you're at currently. And as long as you're making enough money after your expenses, which are pretty much limited because you're a service business, until you hire people, it's not a big deal. You say, okay, well, I'm making X amount after my expenses and I can live off that. I'm happy with that. But once you start to insert other people into the equation, employees, contractors, then you rent the place, you have to pay for more software tools, you have to buy equipment, all those kind of things become a little more challenging to manage from a cash flow perspective. And I'm going to talk to you today about, throughout the presentation, my own experiences, but I'm also going to give you some ways and tips and tricks if you're a business owner yourself in one capacity or another, or even if you're embarking on the entrepreneur journey, or you manage the books for people as an accountant. I'm going to talk to you about the ways that you need to be thinking about cash flow. So that's a little bit about me. So what's the agenda for today? So it's a 45-minute presentation, and then the last 15 minutes has all the questions there for you, the question period where we can talk. So if you could reserve your questions to the end, that would be great. You could put questions in if you want, but we're not going to address them to the end of the presentation. So really, I've divided it up into 3 different sections. So just talking about the first 15 minutes or so is about an introduction, about cash flow, profitability, what you need to be aware of as a business owner, what are you looking for, and then what does it mean actually cash flow if you're not familiar with that term. Then we're going to move into talk about some best practices for keeping your cash flow strong, because it's very much an active thing that you have to actively manage. And then the last thing we're going to get into is, okay, whether or not you've identified cash flow problems through forecasting or lack thereof of forecasting, what do you do about it at that point? Once you have an issue, how do you resolve it? So I'm really hoping you get some interesting stuff out of here, and I'm going to draw some parallels from my day-to-day experience and what we do throughout the presentation. So profitability and cash flow. So the interesting thing is, and anybody who's an entrepreneur here, a lot of this will resonate with you depending on where you're at. And I talked a little bit about that earlier, where you start with the business owner, you're by yourself, then you get really good at that and you have too much demand for your product or business or service. Then you say, okay, well, I need to replicate what I'm doing and now get other people to do that and figure out a way to still make money on that. So if I'm providing a service for $30, I need to find someone to deliver it for 15, or whatever margin makes sense for your type of business. But the problem becomes that as you grow, you might start out your business and you're focusing on what you can do, but at the end of the day, unless you actually translate sales into cash in the bank, sales don't matter. So the focus alone in your business can't be what are my sales. Your focus needs to be what are my sales and how much of that have I collected. I have a lot of business clients, especially people in the restaurant business that are wholesale on the wholesale side. They operate their business and they sell a lot of product, but they actually, if they're dealing with small business clients, and especially hitting the pandemic, they weren't able to collect their money from those clients. So a big sales number is great, but unless you're focusing on collecting that money, it really doesn't mean anything, because without the cash in the bank, you can't run your business. So that's kind of the first point here. I find that's really often people are saying, oh, great, I made sales, but they really need to be thinking of how much of that money am I actually collecting? And we've had a big evolution as accountants and bookkeepers, going from the paper-based approach to now what we have is a digital model. We can run our business really from anywhere. We can work remotely. There's tools to basically speed things up, make things faster, and also, in addition to that, be more accurate. A computer software is not going to make a mistake as long as it's programmed correctly. But if you're relying on an individual, they're human, they can make a mistake. Even just a formula error is going to throw off its entire analysis. So we really have changed the way of doing business, and that's going to continue to change, with the next evolution being AI and involving AI in some of the stuff that we do today. But one thing that hasn't changed is really the notion that cash is king. And that notion is basically saying that cash is the most important thing for any business. So I can't stress that enough, whether you're a business owner or you're an accountant or a bookkeeper or anybody that's advising a business owner, they really need to focus on getting cash in the bank. And as I said, if you cannot do that, you will not survive. It's very plain and simple. So I see this problem time and time again as a business owner myself with my clients, and that is the most important thing you need to focus on, is collecting the money. But it sounds like an easy thing. Well, I'll give an invoice to a client and they'll pay me, but it actually is not as easy as it sounds. It's actually another part of your business that needs to be actively managed. And there's actually companies out there, collection companies, that their job is to collect the money on your behalf. Now, usually people think of a collection company as something you're going to use when someone doesn't pay you on time and you have to escalate it. And that's many times the case. But if you hit the point where you're using a collection company, it's not always your fault, but in a lot of times it means you didn't do things right. Because really, if you structure the relationships properly, you will not have to use a collection company in many cases. Obviously, COVID has thrown people in a situation that they couldn't have ever expected to be in, and that might be a reason why people are not able to pay their bills. But putting that aside, running your day-to-day business, I do see a lot of clients before COVID have those kind of issues where they're just not collecting money from their clients because they don't like to focus on it, whether it's because they don't have the time or it's not a comfortable thing. It's a comfortable conversation to sell your product. It's a comfortable conversation to provide service to a client, making them happy or having a conversation, laughing. It's not a comfortable situation to contact their client and say, hi, where's the money that you owe me? So what you can do, and we'll talk about this, is eliminate the human element or the personal element from that discussion. And that's a way to still accomplish your objective of pursuing your cash for collection, but not, disrupting that relationship that you have with the client or taking an uncomfortable conversation, and bringing emotion into it. And the other thing business owners struggle with, which you're all probably familiar with, is we struggle to delegate things. We think that nobody's going to do things as good as we will. And the reality is there might be a lot of things that no one's going to do as good as you. And those are the core competencies in your business. And that's really how you should be spending your time, is on those things that you're best at and really can't be outsourced. But outside of your core competencies, as your business grows, you really shouldn't be spending time doing things that is not your core competency and you don't do better than everyone else. So I have a lot of business owners that retain control of a lot of the tasks in their business that are of the administrative nature. Now, why is that an issue? Is because you only have so many hours in a day. So if you found a way, you're a great salesperson and you have a great product, and you can sell that product better than anyone because no one knows that product like you or no one believes in it like you do, you should be the one selling that. And these other tasks like collecting money from people, that should be left to software and individuals like an admin person. And that also helps remove the emotional element, because it's not you asking, it's your it's your AR department's following up. Where's our money? We're just trying to make sure we're going to get paid. Where's the money? And that removes you from it. Well, sorry, it's my AR team. That's what you're supposed to be doing. And also, too, people don't want to get too private with their staff in many cases and want to share the information. And but QuickBooks is great. For example, you can set up that your staff only have access to certain aspects of QuickBooks. So they can only access, for example, the accounts receivable module, and their job is only to basically manage the receivables. They won't see the profits of the business. They're just going to know that this company owes me X amount of money. And some people just don't know. They don't know what they don't know. So they're just not that financial acumen there to know that collecting cash is important until it's too late. Either they just are new in the business world and don't know that, or they're just not good with numbers. You might be a finance person, or you might not be. So just knowing what you're good at and being realistic with yourself about where you need help, that's going to really go a long way when it comes to solving this problem. And why is it important? So obviously the pandemic makes this a first and foremost concern for all business owners right now, because the number of customers you have, the volume of your sales is obviously not at the same level probably than it was pre-pandemic. But in addition to that, even if you have sales, depending what type of business you're in, if your sales were on a credit basis before, meaning you would sell a product to a customer but not get paid on the spot, even though your sales have went down, it's a double problem, because the sales you are making, there's also concern, well, am I even going to collect that money? So you have less sales and less collection because there's more of a risk of collection. Whereas if you have, let's say, a restaurant, less customers coming through the door, but every customer that does come in is going to pay their bill because they're paying cash on delivery. And the other thing too is, people kind of go with their gut. And many times businesses that have been around, especially for a long time, they go with their gut and they don't want to analyze cash flow. They might say, well, right now we're late September. If you're a retailer, your busiest time of the year in many cases is coming up, the holiday season. We have Black Friday and then the holidays. A lot of people would say, well, it's my busiest time of the year right now. I don't need to worry about cash because I know I have a lot of money coming in. But the ability to rely on what's happened in the last 5, 10, 20 years of your business, unfortunately, is no longer a reality. You can place some reliance on your past, but definitely it's no longer a good predictor of the future, which the future, as we all know, is very uncertain right now. So especially cyclical businesses, just relying on the past is, not necessarily a way you can go. And in situations like today, monitoring the cash flow is really important because we don't know what's going to happen 2, 3, 4, 5 months from now. If you have a product business, cash flow is important because you need to make sure that you're collecting the money from your clients in time to buy the product that you're going to buy, especially if you have a long lead time. So if your product has a 6-month or year lead time, you're going to need the money that you get today from your clients to help fund that production down the road. So that makes cash flow super important, especially if you have a smaller client base now because of the pandemic, or business, is no longer, half your clients are no longer running, so you have a smaller client base. And as we talked about, you're faced with this cash flow situation, but so are your clients right now. So if you're the one that's very much on top of this and you're the one pursuing them for payment, people are usually going to pay the person who's asking. That might not be always the case, but assuming you have 5 different people you have to pay, who are you going to pay? The one that keeps calling you every day and saying, where's the money? Can I be paid, please? You just might want to get them off your back. So if you can afford to pay 3 out of 5 people, assuming they're all relatively equal in terms of the relationship you have, you're going to want to pay those people. So solve problems sooner. So a cash flow is ultimately going to help you solve problems before they become problems. So what does that mean? Well, if you have a cash flow that identifies 6 months or 3 months or 2 months from now that you might face a cash shortage, I know it's in a perfect world, when you need help, you're able to get help. But anybody that's had a business, and if you walked into a bank and asked for money, you come to realize that unfortunately the system we have, the banking system, the lending system, is not set up in a way to help the people that need it when they need the help. You're better off to go and be proactive and apply for loans or a line of credit, I'd say, because there's no cost to have it, before you're in trouble. because once you're in trouble, the major banks are probably not going to help you. And then you're going to have to go to alternative lenders. There's a whole line of business called alternative lending, which they do AR factoring, and we'll talk more about these things later. But those businesses are in existence for this very reason, that people got themselves into a bad situation. And that bad situation would have been able to be seen in advance of it becoming a bad situation in many cases, had you had a cash flow. But let's say you waited to now and went there to the bank. Banks are being flooded right now with applications from people. So, that not only means that the likelihood of your, application being reviewed on a timely basis is low, but because the economy itself is in a bad situation now, and someone's waiting, let's say now, to apply, the bank has more stringent rules and guidelines for borrowing, because they know, well, it's a tough time. So the stuff that we would have looked at before and accepted, we're no longer going to accept that, because we're nervous about the feasibility of businesses in general right now. And also, if you wait till it's too late and you started to already miss payments, your credit's going to be affected by that. And the harder your credit is hit, the harder it is to borrow. So it'd be nice if people were able to help you when you needed the help, but you need to be thinking ahead why you don't need help in getting money then. So something I've kind of said, but I wanted to highlight this again, you really need to be proactive. That's the key lesson here, is you need to be proactive with managing your cash flow so that you can make decisions in advance of an issue versus reactive. So if we talk about, and I've talked a little bit about these kind of things, but what is a cash flow going to do? It's going to help you know when your money's coming in and the timing. But another thing it's going to do, it's actually going to force you to look at your expenses. So a lot of people were running their businesses pre-pandemic, the ones that were doing well and making a lot of money, especially, they were just happy that they're making a lot of money and that money's coming in the bank and they're good with that, but they weren't necessarily focusing on expense reduction. But once this pandemic came, many of my clients right away said, where can we cut? I mean, that's a natural inclination. When you know that less money is coming in, you need to cut. But if you're doing a cash flow on a regular basis, and this is during normal times, you're always going to have to factor in all the different expenses that you have in that cash flow document if you're doing it properly. And when you do that, you're going to realize that there's probably a lot of things in there that maybe you don't need to have. So I know one of my clients, when we started doing this exercise in March, when things started to go bad, they said, well, let me look. We looked at their credit card and they realized they had, 7 or 8 subscriptions on there for different software tools over the years that they actually don't use anymore. But they had these little subscriptions, $10 here, $20 here, and they just never bothered to deal with it, because when their credit, when their credit card bill came, they just made the payments. And, individually those items are small, but if you add them up, they might equal $200-300 a month. Or $2,400 or $3,600 or $5,000 a year of subscriptions that you're not even using. So again, doing the cash flow is going to help you hone in on these things. And like I talked about, if you have an inventory business, you always need to be thinking ahead. So my clients that are normally selling in holiday time, their biggest time of the year is the holiday season. They're placing orders maybe in June for products that are going to be sold in the holiday season 5-6 months later. So your cash flow is really important, because you're almost having to float the cost for the inventory, you are, for the stuff that's going to come later on down the road. So that's where cash flow is really going to help you. So now we've talked about kind of the cash flow, why is it important, and just some high level things, but what are some best practices for making sure you keep your cash flow strong? So automation. So we went into this. But why not look at a way of automating the uncomfortable task? So for example, QuickBooks, if you're using QuickBooks Online, which I imagine a lot of you are, there is a way to set up an automated reminder that's going to go out to your clients. So you can set up reminders that say payment is coming due. You can also set up reminders that will go out automatically to the client via email saying payment is due. And you can set other reminders letting the client know payment is overdue. So, I think in addition to doing, a regular AR review on your side, accounts receivable review, you should have all these reminders set up for your clients. If you do that and have these reminders going out to your clients, it's really going to remind them of the issues that are, impending they're going to be facing. Okay, well, I'm coming up to the deadline and there's repercussions for that, which we'll talk about. But in addition to that, they will get used to the idea that this type of business that I'm dealing with really wants to make sure they're collecting their money. So I need to pay them, because if not, then there's repercussions. A lot of businesses, I notice, they're very focused on, again, the sales, like I talked about, but cash collection is the most important thing. So if you want to give your clients an incentive to pay you over someone else, what you can do is offer them an early payment discount. So what you would say to them is, if you pay me within the first 10 days of getting the invoice, then I will give you 2% off of the total price, or maybe 1%, or whatever is reasonable for your business, and you build it into your pricing. I know it's ideally you want to collect the whole $100 from your client, but it's better to collect $98 quickly, especially if you're a business that has inventory, than it is to collect 0 or collect 30% or collect the 98 or the 100%, but over 4 months, because all that time and effort you'd have to spend to collect the money from a client, that is all lost time. That if you're the one collecting it, that's an opportunity cost. That 1 hour you spend trying to get that money, if you got one more client from that lost time, that time you could have found another client. Ultimately, you might have lost more than the 2%. So don't be afraid to offer discounts or incentives to your clients to pay early. Set payment terms from the beginning. Most issues in any business relationship, or even a lot of personal relationships, but we're sticking with business here, it's because expectations weren't met. And the expectations weren't met because they actually weren't set from the onset. So what that means is the client signs an engagement or a contract or some type of procurement request from you, and they then develop an expectation of what they should be getting, and they develop an expectation on how they're going to deal with you. And the expectation they have about how they're going to deal with you is probably based on how they deal with their other suppliers or clients at the moment, which could vary widely, to be honest with you, especially if they've been dealing with this one supplier for 20 years and they have a good relationship with them. So if you set expectations from day one saying, here's how we do business. We will give you the product. The first 6 months, you're cash on delivery. This is an example. And then after 6 months, we will move you to collecting money we'll give you a 10-day or 30-day grace period. If you're ever late paying for an invoice, here's the way it works. With your first 30 days you're late, there's a 2% charge, a penalty. And in addition to that, we immediately freeze your orders. If you outline all this at the beginning, both via discussion and in writing, via the contract that you should have with your clients, this is a great way to actually set the expectations from day one. And believe it or not, when you outline these expectations, there's some clients that might decide not to do business with you. And if that client makes that decision, which is very unlikely they would, but I'm saying if a client did make that kind of decision, that's not the kind of client you want. A client you want is a client that pays the bill for the services or product you've delivered. So again, a sale means nothing. Cash in the bank is everything. So set your expectations in terms from the beginning. And the last point here is enforce them. So if the client doesn't meet I guess it's like, a different way of, some people, I'd equate this to bringing up children. If you have a pet, if anyone's ever had to train a pet. So if you do not enforce the behavior that you've set up the expectation for, the person will then learn that they don't need to actually follow the rules. So you basically need to make sure whatever expectations and rules of engagement you set up with your client are enforced. Whether or not you like to do it, you have to enforce it. Again, if a client, you can make a one-off decision to say, this one time I'll give you an exemption from this. But the point is, it needs to be pointed out that this is not the standard practice. This is what we agreed to. We talked about this, you signed it, and this is the expectation. So we're going to talk a little more here. So be flexible with credit cards. So if you don't want to offer early payment discount, or maybe you do, a lot of businesses are cash or check or EFT, but no credit cards. They don't accept credit cards, especially in the service world. I know as an accountant or they want to deal with lawyers, they usually don't want to take credit card. And the reason being is because they don't want to pay fees. And again, it eats into your margin. 2 or 3% on the credit card fee is money that you're not putting in your pocket. But I guess I would say to you, wouldn't it be better just to collect the money, 98% of it, than collect nothing? People, for some reason, like to use their credit card. They'll say, oh, okay, well, I'll pay this person because I'm going to get points. So I know in my firm, we don't accept credit card as a general practice. But if I see there's an issue with a client or the client requests it, or in certain situations, I'm already fully set up to accept credit card. So there are clients where they're struggling to pay, and then I say, well, would it help you if I allow you to pay with your credit card? If the answer is yes, I've solved the problem. Yes, I've lost 2% or 3% of the credit card provider to merchant services, but at least I got 97, 98% of my money. Another thing is cash on delivery to start. So many businesses, small businesses, extend credit immediately when they get a new client. So when you send a product to a client or you provide a service to them without any money in your pocket upfront or in advance, then what happens is you're telling the client, I trust you that you're going to pay me this money that you owe me down the road for whatever I've delivered to you. But the reality is this person's a stranger. So, it wouldn't be prudent to trust a stranger with money. Like, you wouldn't go, if someone was walking down the street and said, I want to borrow $10 from you, I'll pay you back. You would say, I don't know you. I'm not lending you $10. I'm sorry, I don't know you. Well, it's actually the same thing when another business buys a product from you. It's no different. So what you should have, if you want to grant credit to clients, you need to have a credit process. And there are credit reporting agencies for businesses. So I would say it's probably better to do cash on delivery or some kind of deposit up front that at least covers your cost. If you don't want to do that, then at least have a credit process where there's a credit check and maybe they have to give you 2 supplier references. And you contact those suppliers, actually call them and talk to them. And this way, you know that if you're extending credit to this person, that you're actually going to get paid. But I have one client that comes to mind where they grant automatic credit to everyone and then take it away when the people don't pay. And when a person doesn't pay, they don't even stop delivering to that person immediately. They keep delivering because they're so focused on, well, I don't want to lose that client. Well, that client is not a good client. They're actually causing havoc in your business because they're not paying you, but they're actually having a cost on your side to deliver that product or service. So you don't want that client. You want a client that pays. And progress billing is a great way for more expensive projects or service businesses to actually collect money from people on a more palatable way, a palatable basis, but ensure that you're not, at risk from cash. I don't mind being at risk my profit. I mean, that's not ideal, but being at risk my profit is different than being risk my cost. Because at the end of the day, if I at least get the money that it costs me to service the client, which in my case as a service business would be my staffing cost, my overhead, etc., then it means, yes, we didn't make any money on this client, but I'm not any worse off. I learned a lesson. I basically paid my profit to learn to not make the same mistake I made again. I make the same mistake again. So progress billing is great because you can ask the client upfront, it's X amount. This is maybe if you're more of a service business or you're doing a project or product and service mix, but you will then bill them on group pre-agreed intervals, certain amounts. And always make sure that those amounts at least cover your costs to date so that you're not out of pocket. And what it means is that the client gives you $2,000 up front. When you've reached $2,000 of cost on the project, you need to be billing them again. And again, it comes back to what I said earlier, expectations, set everything from the beginning, tell the client this is how we do business. And if the client doesn't want to agree to those terms, then there's probably a risk that they're not going to pay you, because why wouldn't they want to pay you for the work after it's being completed? And if someone does owe you money, follow up with them. As I said, whoever's yelling the loudest, that's the person that's going to get paid. So don't stop reminding them, because they're ignoring you, hoping you'll go away. But if you don't go away, they need to deal with it eventually. So what are some software tools that you can use as a business owner to help you with collection? and help you run your business in the cash flow perspective. So there's a lot out there. I'm not going to get into, the specific details of here's a good software tool or not, but I will give you a few recommendations that I've seen based on my experience. So number one, automate as much as you possibly can. And again, automate means you are not involved in the AR process. It's software tools that are actually collecting the money for you, or at least setting the reminders and then spitting out a report to tell you, okay, this person hasn't paid, go deal with it. Integration, make sure you get tools that integrate with your accounting system so that you don't have to duplicate the efforts. So some people, for example, let's say use QuickBooks for bookkeeping, but maybe they do their AR manually. Like I've seen people still using Word documents because they have their logo on there and they like the way it looks. Get someone who knows how to use QuickBooks to take your template and put it into QuickBooks so that you're using one system. And then if you're going to use another tool, so one popular tool is called Invoice Sherpa. And basically what it does is it helps with the AR collection. QuickBooks can send reminders, etc., but Invoice Sherpa is a little more in-depth. Its sole focus is AR. So make sure you get a tool. If you're going to use another tool for your collection because you have a more complicated business or high volume, and these tools like Invoice Sherpa actually allows people to pay within the software to collect it. So to collect the money, so does QuickBooks, by the way. You can send invoices through QuickBooks and get payment via credit card. But if you use a tool that's not QuickBooks, make sure it integrates with QuickBooks. Because what you want the software to do is to automatically pull the invoice from QuickBooks and issue it. You don't want to have to go into a tool and then input what needs to be issued or chased from the client. You want one source, one point of data entry, which is QuickBooks. And from there, these other tools do everything they need to do. Forecasting, so there are some forecasting programs that integrate well with QuickBooks. Some examples are Float or Helm. For my business today, for some clients, I am using these tools, but for my business, I actually still use Excel. And I'll talk to you about that because it's actually a pretty simple Excel tool that you can use, a thing that I've built, and it's really simple. And then make sure you have a system, whatever this automation tool or software tools you use for both cash flow forecasting and collecting of your AR, make sure it's a scalable system. Just do this exercise once. And what I mean by scalable, you have to think, okay, if I have 5 clients, and let's say that's where you're at today, this system I'm going to put in place works for 5. But would this system also work if you had 10 clients, 20 clients, 50 clients? So whatever solutions you put in place, make sure that you put something in place that as your business grows, it's still going to be relevant and still be able to be used for your clients. So let's say you have a cash flow problem. You've identified it through your proactive cash flow means, which means hopefully you've identified it 6 weeks, 8 weeks, 2-3 months out. But whether that's the case or you found out, because you don't have any money and your bank says 0 and you have to pay your employees next week, which unfortunately is the reality I see. That's what people say, I don't have money because I don't have money to pay my staff. What do you do about it? Well, hopefully, as I said, you're staying on top of your cash flow and you saw this problem coming. But sometimes, if you, maybe it's an unavoidable situation, like your client just declares bankruptcy out of the blue. But in any event, if you have a problem, start to chase. So chase people that owe you money. Be very relentless with that. And as I said, get creative, offer them a discount. Say, well, if you pay with your credit card, would I help you? If you go down the road and you realize maybe this client's never going to pay me, you could involve your lawyer, but there's a cost to that potentially, to write a letter, or maybe you could come to some type of agreement with them. But the point is you need to be proactive now. If you've been reactive, now it's time to be proactive. No longer time to basically sit around and just wait to get paid. Start cutting. So, if you can cut, and we talked about the cash flow before, is going to identify the things that are expenses that maybe, you forgot about, or the discretionary things, maybe you don't need that expensive $1,000 coffee machine with that nice coffee anymore. Keurig would serve the purpose. Start to kind of cut or shift or pause your spending wherever possible. Maybe you can go to your clients, like your suppliers, and say, listen, I have some big clients that aren't paying right now. Can you do me a favor and give me an extra 30 days? Obviously that's not the ideal scenario because you're going to make them nervous, but it's better to be upfront and talk to people than it is just to ignore them and then then if they say, well, why haven't you been paying? You say, well, I have a money problem. It's better to be proactive. People want to help you when they know you're being upfront, honest, and nobody wants to kind of let you fail. But when you just go silent on someone, the natural inclination is to get nervous. So be proactive. And as I said, payment plans are great. So maybe it's realistic that you're just never going to get paid. So why not work out something with them if possible? Hopefully at least covers your costs, but it's better to get some money in the bank right now than nothing. And then you might want to look at financing solutions, as part of the tools that you're going to use. And there's a hierarchy of what's better to use and what's not. And the hierarchy is based on two things, main things in my opinion. One is what's the cost of that borrowing? So banks are always going to be the least expensive option. And then major banks, and then you have the Business Development Canada would probably be your next least expensive option. And then it's alternative lenders, Lending Loop, Thinking Capital, and all these Evolve and Fund Through and Velocity, all these different ones. But the other factor to consider is how quickly can I get that money? So, maybe the bank is the best person and maybe they would approve you, but they're going to take 2 months. And sometimes you don't have 2 months. And then there's companies that have niche focuses. So for example, Fund Through, all they do primarily is invoice factoring. So what that means is they'll say, okay, listen, give me your list of AR. They'll look at the list and they'll say, okay, well, some of your receivables are from big businesses. So we'll actually give you the money now that they owe you, but minus 5 or 10% or whatever they see fit for the situation and the risk. And basically they'll deal with waiting to get paid. They'll collect the money. The one thing I'll point out with these things to be careful about, there is a clause in the contract that says if they don't get paid after a certain period, that they'll come back to you for the money. So it's not like you sell the AR and you're done with it. You can sell your AR to a collections company, but they're not giving you 90 cents on the dollar. They might give you 30 cents on the dollar or 20 cents. So just be really careful when you borrow from these companies and look at the fine print. But at the end of the day, financing is obviously a way to bridge the gap here. And then we're going to go back to my cash flow exercise. So as I said, using a tool like software is great and obviously it's easy. There is a cost to it, and it does help integrate with your accounting software. So if you have a client that has a million different invoices, these softwares are going to pull from AR and QuickBooks automatically and bring it into the software. But here's the one that I created that I use. It's Excel based. It forecasts 8 weeks out. But right now, for example, I forecasted all the way till end of January. So it's more than 8 weeks. But here's how I do it. At the top of an Excel spreadsheet, your first section is called revenue. And basically, you would start there, right above the revenue, you would put your opening bank balance. So top of the spreadsheet, what's my bank balance today? Let's say it's $1,000. So that's what you put in there. Then you have a section called revenue. The revenue section would have all the different inflows that you're expecting. Now, how do you know what you're expecting? Well, you have your accounts receivable. If your bookkeeping's up to date in QuickBooks, you'll know who owes you money, who still hasn't paid. And that's where your bookkeeper is going to come in. So you would say, okay, my revenue or my receipts this week are accounts receivable. If you're not that type of business, maybe you're a retail business or restaurant, or you have recurring revenue, then you'd put some estimate in. So if you're a restaurant, you should say, well, this week here, my estimated sales are $1,000. So you had $1,000 to start, you estimate $1,000 is coming in, and you'd use that estimate would be based on history. Unfortunately, you can't compare probably to last year the same week. So you have to look at maybe last week or very recent times because of what's going on. And then you have the expense section. So you have the revenue section and expense section. So you have 1,000 opening balance, 1,000 revenue. Then you have all your expenses detailed. I do have one expense line called credit card. I don't detail every single item on the credit card. I do just put in, let's say, $1,000 a month or whatever my credit card is on average. So then this way, I factor in a payment to that. And then you always can examine the credit card statement if you want. So in the expense section, you put all the expenses. So let's say those total $500. So you had opening balance 1,000, 1,000 revenue, 500 expenses. Then you have ending bank balance. And the ending bank balance, 1,000 plus 1,000 is 2 minus 5, you have 1,500 at the end of that week. That ending bank balance will now be your opening bank balance the next week for your cash flow. And you would just repeat the same thing. Opening balance, revenue, expenses, ending balance goes to the top. And that will show you what your cash situation will look like down the road. So I find that a really quick and easy way. I update it every single week. It doesn't take me more than 5 to 10 minutes every week. I update it usually on Mondays. But it just gives me a sense of, okay, all else, and I'm very conservative when I do it. So I only kind of put things that I know are coming through, guaranteed. I'm not optimistic. I'm very conservative. I put all my expenses in and I assume the worst case scenario for my revenue. So that tells me, okay, 4 weeks from now, how much money will I have in the bank? And will I have a shortfall? But some businesses go 1 year out when they do this. And QuickBooks actually has a budgeting tool where you can put this in, and then you can run it actually every single week if you want. So if you want to spend the time, you could build something like this into QuickBooks as well. But the QuickBooks is monthly you can build, as far as if I understand correctly. But I do weekly, because week to week is what matters to me for my business and for many businesses. So keep in mind with cash flow forecasting, as I said, it's very brief. The first time to build it will take you a few hours, but once you build it, it'll take 5 to 10 minutes. Be proactive, so jump on things that you see as a problem as early as humanly possible, and be conservative. So make allowances for currency or interest rate changes, be pessimistic, assume your business is not going to grow, assume the worst case scenario. This is just a cash flow. I'm not trying to be pessimistic in your business trajectory, but for this purpose here, be pessimistic because you'll need to solve the problem if all those negative, outcomes become the reality. So just some kind of things to sum up here as we conclude the presentation. Never confuse sales with cash flow. I know we talked about this a lot and I said it many times. A sale is only a sale once the money is deposited into the bank. If you do not collect money, your cash flow ends. And if your cash flow stops, that basically causes a chain reaction. You can't pay your employees, you can't pay for your products. And then if you can't make those payments, then those will create other problems because people won't work for you. If they don't work for you, then you can't service your clients. It's basically like a vicious circle that's going to, really just get worse and worse as time goes on. So you really need to make sure your cash flow is your primary focus. And like I said at the onset, we live in an unbelievable time. There's so many great tools and ways to make this all nice and easy and digital for you. So you don't have to do this in a way that's going to be time consuming and difficult and complicated, and hire an accountant bookkeeper to manage this process for you if it's something that doesn't make sense for you to handle, or you just don't have the financial acumen. Focus on what you do best and outsource the rest. That's something I always live by in my businesses. So now I hope you enjoyed that presentation. We're going to jump into the question and answer here period. So let me just expand this here. Oh, there's a lot of questions, which is great. I'm just going to make this a little bigger here. Okay. So I'll get through as many of these as I can. So one question is, how does one give permission to employees to only access certain parts of QuickBooks Online? So when you add a user to QuickBooks, it asks you what kind of user that you want to add, and you can then do a custom user, and there you can actually customize the level of access for the person. Next question is, what amount of interest to charge your clients is suitable? I would say it's a great question. I think the best thing to do is to look at what your competitors are charging, if that's possible. But I mean, it's not meant to be punitive. You could put in there, 5% per year, 10% per year. I think the whole idea is it's just as long as it's some percentage that there's a penalty associated, it means that your bill gets bigger to the client. It becomes a larger expense if they don't pay you on time. Don't put something like 1% because that's just not going to encourage someone. What I typically see is 2% per month is what I typically see, which is, let's say, 24% a year. That's what I typically see, but be in line with your industry if that's possible. Is there a rule about how much you can charge for late payments? Probably, but I'm not an expert in that. There are government rules surrounding interest rates, but if you use 1 or 2%, you're definitely not going to breach those rules. I'm not a lawyer, but I don't think you breach those rules if you use that kind of percentage, because credit cards are higher than that. Do the revenue and expense numbers, do revenue and expense numbers include tax for the cash flow? That's a great question. So I do not put any tax in my cash flow, HST or sales tax, depending what province you're in. The sales tax is left out of my revenue and expenses, but I do have separate, and I personally, all the money that comes in for I have a percentage, I allocate that, I transfer that to a separate bank account. So my HST money is aside. I'm paying corporation and HST installments, which means every 3 months I have to pay the government anyways. But in my cash flow, I do have a section there where I will put the amount of payments that I have to make to the government. So yes, I don't include them in the numbers in and numbers out, but I do include, I have a line for income tax installment payments. But I have my savings account also, my cash flow, so it captures that. Is this cash flow analysis aimed at smaller businesses? Most of your clients, you medium-sized, have more than one bank account. Furthermore, why wouldn't you allocate your expenses according to operating, investing, and financing? So Andrew, another Andrew asked that question. It's a great question. So I have clients, I'd say a lot of the smaller businesses, yeah, you're right. They won't have too many bank accounts. They might have 2, 3, 4, 5. For bigger clients or more complex, that's where I said a tool would be better than probably doing things in Excel. So in operating, investing, and financing, I'm trying to present a tool that is very easy for a non-accountant to use. If I start to say divide the operating, investing, and financing sections of a cash flow statement, that's an accountant's cash flow. If you show an accountant's cash flow to the average business owner, they're not going to understand it. So that's why I wouldn't divide it up like that, because you have to also always do something in your business for the user of that product. So I could present a cash flow in a way that I understand, but does my client understand it? My client understands here's what's your bank today, here's what's coming in, here's what's going out, that's what you'll have at the end of the week. If I say, well, here's your amount of your cash that you're allocating for investing activities versus operating activities, the client gets confused. Do I have a template for or Excel worksheet or screenshot? I do have a template. I don't know if I'll be able to share it. I'll have to ask QuickBooks. I'm happy to share it if I can. Can you pre-populate your Excel template with QuickBooks data? Yes, you can to a certain extent. The one I use, no, but you could take the one I use and build a macro and do it if you're an Excel person. What if your company's acting as a subcontractor for a large contractor? So, unfortunately, if you're a subcontractor for a large, you're kind of at the mercy of that contractor. So sometimes there's a lot of project payment delays, hard to control. Is it ever okay to require a deposit from a GC? So I would say, should you ask your general contractor for a deposit? That's an industry thing. It also depends on your trade. So are you in a trade that's in demand? At the end of the day, if you're in demand, you have leverage. If there's $1 million of what you're doing, your trade, then if general contractor doesn't like your terms, they'll go find someone else that they like their terms. But if you're good at your work, and or you're a trade that's hard to replace, then you might have some more control in that relationship and you can ask them for a deposit. But yes, if you're a subcontractor, you're really just at their mercy. So unfortunately, it just means you need to stay on top of them. And if you don't think you're going to get paid or you're unhappy or you're nervous, then you shouldn't do business with them at the end of the day. But it's a little harder because you don't have control over the client who's ultimately paying them. Could you pass on the 3% credit fee to a client, credit card fee to a client? So I don't know if there's a law against that. I would just build it into your pricing. It's all about optics, because if you tell the client, I'm charging you this plus the credit card fee, optically it's better that they just pay the amount and the fees in there. But you could have the discussion. I don't know if there's a law saying that we're not allowed to do that, but I have seen some people do it, but it's rare. Usually when you go places, you don't have to pay a separate credit card fee. Someone liked my forecast. Thank you so much. I appreciate that. I've been doing cash flow budgeting for 1 year or longer, and it was way too much for the job, like writing a novel. Thanks. That's funny. Any tips for tax season? I mean, that's really out of the scope of the discussion, but I will say the focus this year, the government's spending a lot of money. A lot of money's flowed out via subsidies and whatnot that people are aware of. So be careful about these subsidies, because I think there is going to be audits and reviews, and just be prepared and have your numbers and everything in a row for tax season. I also think that there will be more random audits on, like the government mails out letters. So they'll pick categories and they'll mail things out to people and just say, give us a list of all your expenses. I do see more audits coming down the road, because the government does need to figure out a way to recover all the money that they've been spending via these programs. So I think the recommendation for tax season is just make sure you have your books really, really good shape this year. Someone's question, I'm curious, what would be the best way to evaluate companies during COVID? Expenses can be overstated during this time. Many companies, so I think the question is, how do you evaluate a company during COVID? Unfortunately, like we talked about, you can't use history, which you're alluding to here. So I would evaluate them based on, their sales. So I would, number one, I would look at how affected are they by COVID? Some businesses, to be honest with you, basically no impact. And some businesses are doing better than ever. So that's one way to look at it, is how affected are they by COVID? That's like a risk factor. And then, by now you should have an idea. I would take their kind of July, August, September sales, and I would apply a downward trend to that, because I think we're going to unfortunately go into a slower period for the next few months. This is like a kind of a second wave. But yeah, historic is not the right thing. I would look at the last 3 months, and that's what I would base my decisions on for valuing the company. What are pitfalls of using a third-party cash flow software with QuickBooks Online? Pitfalls, there's a cost and there's a learning curve. And it's not 100% customizable. But there are some out there that I've used that, which is nice, is that you can just export the result to Excel and then edit it if you want yourself. But there's not really any pitfalls beyond the fact that there's a learning curve and there's a cost to it. Someone works for a real estate investment trust. They've been collecting rents, but it's been an issue during COVID. How do you look at the government subsidies coming in, as they depend if the tenant is eligible? So I think that question surrounding the cash flow, if you are going to get a subsidy from a tenant, from the government on behalf of a tenant, how would you look at that? I would view that as assuming I don't get any money. That would be one of those kind of situations, meaning I would just assume I'm not getting any subsidies, or a very conservative amount for the purposes of my cash flow, because you want to assume the worst for a cash flow. That's what I would do, and I own property myself. Someone thanked me. I really appreciate that. Thank you for attending today. Next question here. I charge my clients in USD since they're outside of Canada. QuickBooks doesn't support USD. No, that's not correct. QuickBooks does support USD. You just have to have the plus version, and then you can turn on what's called multi-currency, and then you have any currency you want. So that should answer your question. You definitely use the QuickBooks right version and then enable multi-currency, and then you can actually do US dollar. I've seen businesses that don't charge credit card fees but offer a discount for e-transfer. Yeah, that's great. I mean, that's just another way. The end message here is figure out a way to make your bill more attractive than others. What do I think about QuickBooks Cash Flow Tool? I'll be honest, with the QuickBooks Cash Flow Tool, I haven't used it too much because it's early stages, so I can't comment on that, unfortunately. How do you use cash flows for projects that clients are planning to implement? Also, what is your opinion on discounted cash flows for evaluating buying, selling companies? Discounted cash flows for buying, selling companies, it's right for certain types of businesses. Unfortunately, we usually use history for that. Like we say that, okay, the past has been like this, so we're going to forecast for the future. But as you know, ultimately, we can't rely on the past right now. So I don't think they're as applicable right now. I think you would want to do some sensitivity when you do that. And the second question is, how do you utilize cash flows for projects that clients are planning to implement? I don't quite know the answer to that question. I think you're saying if a client is implementing a project, how would you factor into that cash flow? You would just need to get the best estimates of the cost of that project and if there's any resulting revenue and plug that in and be extremely conservative. And then I would even build a budget for that and run that budget to actual for that project on a regular basis. Is this full webinar after this presentation available? We're giving out a white paper that I wrote, and it has all this content in it. And we're also providing this recording, but we're not giving the PowerPoint presentation, but the information should be in the white paper I wrote. So you'll be getting those two pieces. And that's it, everyone, no more questions. So I really appreciate everyone attending today. I hope you found that informative. Even if you just got one thing out of this, 1 hour of your time for one thing that's going to help your business, run your business, is totally worth it. So thank you so much, everyone. I really appreciate you attending today, and I hope to speak with you again in the future. Thank you. Thank you. Very nice compliment. It's nice. I'm getting red if anyone can see. I appreciate the compliment. So thanks, everyone. Have a great day.